All right, everybody. Rick here. Happy Monday, the 9th. Okay. So everybody, I hope everybody is excited. Looks like the market's already picking up a little bit and everything's looking good. Interest rates, well, we're going to talk about that in a second, actually. We're very fortunate today from Prosperity Mortgage to have Mr. John Ingram. John, if you can hit *6 on your phone, that'd be great.
Already done.
All right, my man. Well, tell us a little about yourself. How long you've been doing this? You know the drill.
Sure. Yeah. I'm about 20 years in the industry. Been linked with Berkshire basically that whole time. Excited to do that. Held multiple positions through the industry, always on the sales side of things, whether it be loan production to now just being branch manager and a producer myself here in Vegas. And yeah, grateful to have found this career for sure.
Yeah, it is a great career, and you do it so well, and all that's awesome. And you've been like I've been here a little over 8 years now, and you've been here for a couple of different mortgage companies. And the great thing, and the only reason I say that is now the consistency of both being corporate owned and so forth has got to be. It is comforting for me. It's got to be for you too.
Yeah, it's a little weird to think about. This is, most likely going to be the last company I ever work for, right?
Right.
I mean, Berkshire does not sell off what they're doing. So, yeah, being a Berkshire Hathaway company, this is probably the last one. So there you go.
That's the way I look at it too. And Uncle Warren, whether the market's up, down, or indifferent, he's got a little money behind him so he can weather any storm, which makes it nice. That's
true. And in our world, what that means is, as companies have gone through the stress of this slowdown, we've been hit up by quite a few to say, hey, what do you think about taking over and buying us and this kind of thing. So the deep pockets of Berkshire Hathaway certainly make a difference. It allows us to cut the best deals with the secondary markets and our cost of money and that sort of thing. It's really an advantageous position to be in.
Sure is. Same with real estate too. Same thing. A lot of companies have, as you know, if you watch the news or whatever, or read the paper, this company's having no names mentioned. There's a couple of companies went out. A couple of companies are, but and that's only. And think about that. That's only a little blip, really. I mean, you know what I mean? And it's all because a lot of companies design themselves around the pace of, I will call it, April 2020 to December 2021, and that just wasn't reality. Was it?
Sure. No. Yeah. That feverish pace was just unheard of, and it's one of the crazy things that been in conversations I've had, which is to go from the best real estate market and mortgage market in history and not to be making money during that is a crazy thought. Yet there are multiple companies out there, real estate brokerages that went public during this time that lost money the whole way through. And what that's got to do to them now with fewer transactions happening is got to be soul crushing to them as a business for sure. And the same thing in the mortgage world, where you have, and it happens every single time, you have companies come out and they mine refinances, the way we talk about it, where they just a refinance house and they try to come in with the slimmest margins and just do as much business as they can. Well, that is a boom bust cycle, and right now they're busted. They're out of business, and ultimately, and it's only those that stay loyal to the purchase world that can ride out the thick and thin. And ultimately, it's something that we're, as an organization, we're proud of. Is like we're a purchase focused organization built by realtors, right? This company was started by a real estate company. Our mortgage company was started because of that and designed around that, and that's the way it's sort of in the DNA of this company to stay true to that. We'll do every refinance we can. Wonderful, yeah, happy to help. But our bread and butter is purchase and rain or shine. And this is one of the things that I've always appreciated about Berkshire, and I've said to people that have come and gone, is it's been lucky enough to where this has created a great career for me. Year in, year out, good times, bad times, that whole thing. I've been able to, keep the lights on and have a healthy business because I stayed close to realtors and the purchase side of the business.
Right. And that's where to be. As a company, I know a lot of companies don't get that. You're right. But if you stay with the purchases, even when things get, upside down, indifferent, whatever, that's where the pulse is because, refinances come and go, but the purchases are what keep chugging along, right?
Yeah, because even in this, lower transaction market, there are people that need to buy and there are people that need to sell, and there's always business being done, right? And then I love, this is something Mark Stark kind of said back in the day, but was regardless of how many or how down the market is, let's say how many fewer transactions, there are still more than enough transactions for me to have my best year ever, you to have your best year ever, right?
Right.
You just have to go get your share.
Yep. Absolutely. And let's get right into that. So, my theory, we've talked about this, and, we had a manufactured unbelievable market. COVID, even though COVID at first looked like it was going to be paralyzing, it ended up being very helpful for the real estate markets for a lot of different reasons. And now we've been through that. And now, the Fed comes in and starts climbing this rate at, I was going to say historical, but they're even past historical. So I think we went from manufactured, the market would have been good anyway, but I think it was helped manufactured good at the end of, when COVID loosened up and people started, going crazy. Now it's kind of manufactured bad because it went from 3%, to over 6% interest rates in a very short period of time. But even though those are still incredible rates, people are starting to see it. And I think that, they're going to start coming off the sidelines. I think we're already seeing that, right?
Well, that's something that we think we're all looking towards, and I see looming in the future, which it brings a couple of things up for me. But
yep.
Yeah, I mean, the prediction right now is that we'll see down towards 5% in the first 6 months of this year, right? And as that happens, I think buyers will be re-energized and come back into this marketplace at probably a faster return, kind of like the tide coming, going out and coming in, but a fast return to increased volume in this market. Now, I don't think necessarily that it's going to go back to the fever pace, is the way I describe what happened through the end of 2020 and certainly into 2021. Where we built a real fever in this marketplace, and we're just doing transactions so fiercely, right? That was certainly destroyed over the last 6 months or so, or at least crushed is maybe the way I'd say it. And it only feels like you got crushed because you were going 100 miles an hour, right? You slow down to 50 miles an hour, and it feels like you're walking, but you're still going 50 miles an hour, right?
Right.
So that's it's so much of it is perception based and this sort of thing, and I think that works in our favor because one of the points that I'm kind of sharing with people is that interest rates don't have to go back to 3% in order for people to get excited. I think them going down to 5 or close to 5 is going to get them off the bench, right? You only have to taste a 7 to know that 5% feels good, right?
Right.
and so that's the market we're heading in. So it's really an interesting time as agents. I would be, there's a couple things on this. One is I think 2023 is the year of you telling consumers or helping them to see that it's not as bad and it's better than what you think it is, right? The interest rates, if you talk to people, they're going to tell you they think they're around 7, right? When in fact they're close to 6.25 today with no points. You start throwing points at it, you can get in the upper 5s, mid 5s. You do creative things like 2-1 buy downs or what we call temporary buy downs to interest rates. You get awesome seller concessions today. There's a really there's a nice window of time that a certain amount of people are going to use the Berkshire Hathaway purchase method. You think about Warren Buffett, right? Warren Buffett loves to buy companies when everything is doom and gloom out there. That's when he comes in and makes his best deals. And that's sort of the moment in time that we have right now, where interest rates have softened a bit. They've come off of the peak where we hit 7.25, 7.3 at the peak, and have come down to about 6.25-ish, let's say. But while they have come down, there's still air to breathe with sellers, where you're getting these good negotiations. I mean, it's now maybe 1 out of 3 contracts that I'm seeing that don't have any concessions, right? So the majority of the transactions do have concessions. You're able to negotiate for the best deal. So as a buyer who's able to move in this marketplace, now is really the sweet spot to do it before the rush of buyers comes back into this. Because once rates are 5.25% and 5%, and everybody knows that, all these good deals are going to get sopped up. You won't be able to rip a seller's head off, for example, and negotiate for everything, right? So it's a really, like, I think, a good time for a buyer to come into this marketplace and negotiate an amazing deal on the house, knowing that the interest rate that loan has can be replaced later, but the house can't. Right?
Right.
You have to control that house and that property that works for you and your family now, so that when and if interest rates get to a better level, you'll take advantage of that through, a potential refinance opportunity, that sort of thing. That's the moment in time I think we're in now. I think that's over. June, July, it's over. I think the market will have tightened back up, and all these amazing deals will be reduced, because at its core, the imbalance between supply and demand, the supply of homes, is not changing dramatically. Builders have learned their lessons and are not overbuilding homes. There's not an oversupply of properties that can overwhelm this market. And very quickly, as demand comes back, the supply that we do have will be used up and shrunk again. That's right. That's kind of what I see.
I totally agree about getting the deal right now. I don't understand. Well, I think that's what's, a lot of people are saying they're having more activities on their listings. And, it's only the second week of the year, but I'm talking to a lot of agents that are already telling me that. And I sold one I had since, November of last year. And I think it's because people are realizing that this is, just like you said, John, this is the time to get a deal, and you can buy the rate down and then just wait. I mean, listen, if you do a 2-to-1 buy down, you literally can wait for 2.5 years, or more. I mean, at least 2 years, but you won't need that much to just convert over and have it go to a fixed rate. So, and any money on the side, that step aside, will be directly come off the principal. I love that idea. It's such a great program. Tell them a little about that.
I have a client right now who's actually taken advantage of all the options, and their interest rate's starting out at 3.25. So they're doing the temporary buy down, and they did a permanent buy down to their interest rate. They used all the levers to get their house to be the most affordable it is, and so now they get to ride that out for a couple of years. Yeah, when you're talking about temporary buy downs, there's a couple of variants that are in the marketplace, but ultimately what this is a 30-year fixed mortgage with a temporarily lowered interest rate. And really it's not even the interest rates that changed. It's the and I'm going to get overly technical for a second. It's a subsidized interest rate. So with a credit from the seller is basically funding a prepayment of your monthly payment that lasts for 2 years or 3 years, or depending on the variant you have. But effectively, the seller is giving you a credit to prepay those dollars and then you're paying a lesser portion because your interest rate that you're actually paying the bank is the same. The actual permanent interest rate, using today's numbers, let's say 6.25%, is actually what's being paid to that loan. It's just 2% of that 6.25% is being paid by the seller, and you're paying the remaining 4.25%. Right? That's kind of all mechanically happening there. The good news about that is when they are structured and done this way, if interest rates fall in a year and you replace that loan, none of that money is wasted because that money is just sitting there waiting to be credited against your loan. And so if you refinance, all those dollars get immediately applied to the balance of your mortgage, making it lower, and you're refinancing the remaining portion, right? Unlike a permanent buy down, which is I'm spending this money to actually make my permanent interest rate lower. If you refinance that loan, then all of the money you spend on that buy down is potentially lost, right? You don't have time to recover it through your lower monthly payments, right? So that's the advantage of these temporary buy downs. I find myself spending a lot of time emphasizing the mechanics of it with people so that they don't get misled. The worst thing would be to have a repeat of some of the problems of 2006 and 5, where these loans came out of their adjustment period and then people couldn't afford them, right? And so every one of these loans requires the borrower to qualify with the bad case scenario on the loan, which is the permanent interest rate. That's what you're qualifying on. And I'm making sure to have conversations with the consumer that, yeah, we want to be ready to refinance and potentially lower this rate, but I need to know that you and your family are going to be okay if that refinance never happens. If you end up reaching that permanent interest rate and that higher payment, that you're still going to be okay. That's the I think the respectful way to work at it, and it requires a couple of additional conversations.
Right. It's like, I'll give them a perfect personal example. It's like when I first moved here and, I introduced to you and I bought a place, and then Tina and I, you told me, I said to you, hey, the rates are much lower now. You said, just wait, because at the rate it is versus what you currently have, it's not that great right now. But if it goes down, and my personal residence is at 2.9, and I got a couple investment properties at 3.1. That's way better than a sharp stick in the eye.
No, it's amazing, right? It's literally once in a lifetime.
And that's exactly what it is.
For sure. It was an amazing opportunity. In order to make it happen, you had to have the COVID shutdown, and you had to have the Fed cut the interest rates to zero as far as the Fed funds rate, right? And they were out there buying mortgages and treasuries hand over fist, right? It took both those things to happen in order to get interest rates to kind of crack that 3% mark and kind of go sideways, which is, wow, what an amazing gift to those of us that have those. But that was extremely abnormal. One of the biggest things that's kind of at play right now that doesn't get talked about very much is the fact that the Fed has stopped their buying of mortgage-backed securities and treasuries, and in fact are letting about $65 billion a month run off. Basically, they are tightening the money supply by letting these bonds get paid back and then removing that supply from the marketplace. This is another major tightening that's happening at the same time that just doesn't get talked about very much, but is a really powerful force in the marketplace.
Yeah, explain to them what that means basically, because that's I have an idea what you're talking about, but just so they can,
So the Federal Reserve, they were out there and they were acting as a buyer of mortgages and a buyer of treasuries. Like the United States Treasury would issue this debt, and the Federal Reserve would buy it. We would do a purchase mortgage, do a refinance mortgage, and we would sell it to the market, and ultimately the Federal Reserve was buying the bulk of that stuff, right? So that's how they accumulated a $9 trillion balance sheet. That's what we talk about. They had over $9 trillion of bonds on their books. And so that is not normal for them. That's them trying to assist the economy and the world and stabilize it and to be that buyer of last resort when maybe other people are playing it more safe with their money. They have a sort of unlimited pocketbook, right? Well, now right. We're in a situation where they begin reversing that process. And so their $9 trillion of mortgages, it's not all mortgages, but the $9 trillion of bonds that they have, every month a certain amount of those mortgages get paid off. A certain amount of them get refinanced. And now every time a mortgage gets paid off or gets refinanced, instead of going out and buying another bond with that cash, they're simply saying, okay, I'll put that back into my pocket. And every time the Federal Reserve puts money in their pocket, they're removing money from the world economy, from the money supply. You are tightening conditions because they are the ones who create and destroy dollars. They're the only ones. Everybody else just circulates them, right? And so every month there's this natural amount of refinance and payoff activity that comes in. And so right now they're letting run about $65 billion a month of that to naturally expire, and the rest they're able to reinvest into new debt. So they're not. Go ahead.
Yeah. It's not like I had a $10,000 credit line on my credit card and I paid off $2,500, and then the bank lowered my credit limit to $7,500. Right? It's like it's kind of like that, but they're not reducing it by the full amount.
That's basically correct. If you think about like the Federal Reserve as the credit card and the economy as the borrower, or like is the individual, sure, they're removing money supply from the system in order to as the core issue is to slow inflation, which we can clearly see it. I can't wait to see you in the Success Series this week, but I've got some new charts showing it's going to really, I think, help people to understand the mechanics of what's going on. But if you look at the most current data, like what's happening right now, as opposed to instead of looking at stuff from 11 months ago, inflation is way, way down and is sending such positive signals. And it's one of the largest reasons why we think interest rates will fall from where they are. Even though the Federal Reserve is tightening and raising interest rates and keeping them elevated, and they're telling everybody we are not cutting these rates until at the earliest 2024, they're going to keep their foot on the brake. Mortgages are still have plenty of room to go down from where they are, because they are, in a way, they're abnormally high right now.
Yeah, a lot of the next moves are baked into them already, so they just level out and they can start heading them back the other way, which is great.
Yeah, one of the interesting things mechanically that's happening underneath the surface is normally mortgages trade about 1 or 2% above the 10-year Treasury, right? So 10-year Treasury today is 3.5. In normal world, mortgages would be about 5.5, but instead today they're at 6.25, and that's part of the sort of the rubber band motion that we're expecting to happen, where it's stretched out farther from its historical norm. For 35 years, it's always been pretty stable at between 1.75% and 2% above the 10-year Treasury. And with us being closer to 3% now above the Treasury, that's abnormal and will reverse itself. And it'll be one of the reasons why the Fed can do what it's doing and stay the same, and mortgages can still go down. There's a lot of interesting technical things that are happening underneath the surface that are all in our favor going forward in this year for real estate. I think, we reached here's a couple more numbers for you, if you don't mind. In normal world, we do about 1.75 million, so 1.75 million home sales in a year. that has fallen down to a pace of about 1.3 million homes being sold. So there's a lot of upside for us to return to normal as the volatility settles out of this marketplace. It was a really big problem to have interest rates go from 3.5 to 6 so quickly. That threw a shockwave through the marketplace, and it's causing pent-up demand. It's certainly not as severe as shutting down the economy in March of 2020 and saying nobody do anything. It's not as severe as that, but there is a certain amount of pent-up demand that will come back in this year. And so it's going to be our job to be there to help those people when they're ready for it, to have our best skill sets ready to go, to know about what's happening in the market, to be able to talk about the best strategies happening today to get them the properties they want, whether it be homes for people to live in, whether it be the next investment property for them. That's the opportunity that people have this year, is to be able to give the information to the people when you come into contact with them. If you're that agent that is ready to kind of talk with facts instead of feelings, you're going to benefit from that going forward, because it will happen this year.
Cool. And I'm looking forward to seeing your extended version on Thursday as well. But I think what the message today is, get your buyers to see that right now. I mean, they interviewed they did a survey of X amount of people that bought from April of 2020 to the end of 2021 during the COVID time, and 65% of them felt rushed. I settled, didn't get exactly what I wanted. Right now, your buyers, even though it's a two-step process, right now your buyers can get exactly what they want, take their time, have a home inspection, have stuff done at the home inspection, get the seller to contribute towards a buy down. There's all kinds of great things. And most importantly, get the house you want. Because like you said earlier, John, this is the time, right?
How amazing is that, to have options, right? To be able to choose between 3 or 4 different houses and pick the best one, not just the only one you can get, right?
Right.
That's been lost for a couple of years for buyers. It was it was everything you could do to get your contract accepted, make every sacrifice in the book. And it's something that, we can be excited about and feel like, hey, this is such a good thing for buyers to not have to waive contingencies, to be able to negotiate some credits, to negotiate the better price, to be able to choose between multiple properties to find the best fit for their family potentially, and not going in totally disadvantaged. I'd much rather be a buyer in today's market than November of 21, October of 21.
Right.
That was rip your head off times for sellers, and happy to leave that far behind.
Yeah, and then so don't look back, and then when it picks back up again, you go, there's comfort when it picks back up, but you don't get the same type of deal as if you take a little bit of a risk, even though, but to me, home ownership is never a risk. It's like putting money in the stock market. If you leave it there, you're going to do better. Same with real estate, plus the tax advantages, and rents aren't going down either. But all right, John, we got to call it a morning. We're right at time here. So I just want to say, John Ingram, thank you very much from Prosperity Mortgage for taking your time out this morning. Look forward to seeing you on Thursday. And everybody, as John just said, we have Success Series going on this week at the St. Rose office, 1 to 4 every day. So hope to see you guys here. Thanks, John.
Thank you. Bye-bye.
All right, bye-bye now.